Something unprecedented is happening in Florida right now. And I'm not talking about hurricanes or tourist season. I'm talking about a complete and total collapse of one of America's hottest housing markets. A collapse so severe that the governor himself broke down in front of cameras, his hands trembling on the podium, unable to explain how it got this bad. Picture this. You've saved for years. You finally get your dream home in sunny Florida. The contract is signed, the inspection is done, your loan is approved, you're days away from closing, and then without warning everything falls apart. Your insurance, quote, doubles overnight. Your lender pulls out, you lose your deposit, and you're left standing in an empty room wondering what just happened. This isn't a rare occurrence. This is happening to 15% of all home sales across Florida. That's roughly 1 in every 7 deals dying before closing. But in cities like Orlando and Jacksonville, it's worse, much worse. 1 in 5 contracts is collapsing. 20% of buyers are walking away from homes they desperately wanted just weeks earlier. And here's what nobody saw coming. The median home price has crashed $55,000 in just 6 months. $55,000. That's not a correction. That's a free fall. Neighborhoods that were selling homes in bidding wars 18 months ago now have entire blocks lined with for sale signs that nobody's calling about. The dream of Florida living is turning into a financial nightmare for hundreds of thousands of people. But the real question isn't what's happening. It's why. And when you dig into the details, when you look at the insurance bills, the hidden fees, the lawsuits, and the desperate investors fleeing the state, you realize this isn't just a Florida problem. This is a warning sign, a crack in the foundation of American real estate that could spread to your city faster than you think. Let me take you inside the collapse. Let me show you the real numbers, the real stories, and the real panic happening right now in America's third most populous state. Because what's unfolding in Florida isn't just about houses. It's about trust, stability, and the American dream itself coming undone. It starts with something that seems simple, a signed contract. For generations, when you signed on the dotted line to buy a home, that piece of paper meant something. It meant security. It meant the deal was done. But in Florida right now, a signed contract means almost nothing. The data is staggering. Earlier this year, in the peak of spring buying season, nearly 15% of pending home sales across the entire state failed to close. Failed. These weren't people changing their minds or finding better deals. These were families and investors who desperately wanted these homes, who had jumped through every hoop, who had their financing approved, and who watched their dreams evaporate days before moving trucks were supposed to arrive. In Orlando, the cancellation rate hit 20%. 1 in 5 deals dead. Fort Lauderdale, same story. Jacksonville, even worse in some neighborhoods. The MLS records paint a picture that veteran realtors with 30 and 40 years in the business say they've never witnessed. Not during the 2008 crash, not during the savings and loan crisis. Never. Here's what it looks like on the ground. A couple in Miami spent 3 months looking for their perfect home. They made an offer. It was accepted. They paid for the inspection. They got their loan approved. They gave notice at their apartment. They started packing. Everything was set. Then, 72 hours before closing, their insurance quote came back. Not the $3,000 they were told to expect. $7,800 for 1 year. Their lender took one look at that number, recalculated their debt-to-income ratio, and pulled the approval. The deal died. They lost their deposit. They lost their inspection fees. They lost their apartment, all in one afternoon. And she's not alone. In Jacksonville, 45% of homes that went under contract earlier this year came back on the market at least once after a failed deal. 45%. That means nearly half of all sellers watched their sale fall apart and had to start over. Some homes have cycled through 3 or 4 failed contracts, each one adding another layer of desperation, another price cut, another month of mortgage payments for sellers who have already moved out. Tampa brokers describe entire weeks where every other closing is at risk, where title companies are making emergency calls at 9 p.m. because an insurance carrier just backed out, where mortgage officers are breaking the news that the numbers no longer work, where buyers are sitting in parking lots crying because they can't afford a $7,000 insurance bill on top of their mortgage. The reasons pile up like a car wreck in slow motion. Insurance premiums that spike without warning. HOA fees that double overnight and get revealed only after you're in escrow. Mortgage rates that push monthly payments $200 or $300 higher than when you first got pre-approved. Special assessments that hit condo buyers with $50,000 or $60,000 bills before they even own the property. Some buyers walk away because they simply cannot afford what the final numbers look like. Others walk because they realize they're buying into a trap, a home that will bleed them dry with costs that keep climbing. Even seasoned investors, the ones who weathered 2008, the ones who bought entire blocks during the pandemic boom, are retreating. In Fort Lauderdale, institutional buyers who once closed deals sight unseen are now pulling out mid-process, their risk models flashing red, their analysts warning that Florida has become too unpredictable, too volatile, too dangerous. Local mortgage officers tell the same story in every city. Approved buyers getting rejected at the last minute because lenders now demand proof of paid insurance premiums before they'll release a single dollar. If the policy can't be bound, if the carrier backs out, if the quote comes in too high, the sale is dead instantly. No negotiation, no second chances. The scale is almost incomprehensible. More than 18,000 sales were canceled in the past year due to insurance disruptions alone. 18,000 families, 18,000 dreams deferred or destroyed. In some neighborhoods, the same house has a for sale sign that's been up so long it's faded in the sun, cycling through buyer after buyer who can't make it to closing. The uncertainty feeds on itself. Buyers are terrified to make offers because they've heard the horror stories. Sellers are desperate but can't lower prices enough to compensate for insurance costs they don't control. Real estate agents are attending city council meetings begging for solutions. And the old rules, the ones that governed real estate for decades, simply don't apply anymore. Here's the bottom line. In Florida right now, a signed contract isn't a guarantee. It's a gamble, and the odds are getting worse every single month. This isn't just about falling prices anymore. It's about whether homes can be sold at any price, whether the basic mechanics of real estate still function, whether the market itself is broken beyond repair. Now, before we go deeper into this crisis, if you're finding this information valuable, if you want to stay ahead of what's happening in real estate markets across the country, do me a favor. Hit that subscribe button. We're pushing toward 10,000 subscribers, and your support helps us bring you the real stories behind the headlines. And drop a comment below. I want to know. Have you experienced this in your state? Are you seeing insurance costs spike? Are deals falling apart in your market? Let's talk about it. Now, let's talk about what happens after these contracts fall apart. Because the wreckage doesn't just disappear, it piles up. And right now, it's piling up faster than anyone can clear it away. By summer of this year, Florida's median home price sat at $390,000. That might sound high. That might sound like Florida is still expensive. But here's the critical detail. Just 1 year earlier, that median was $445,000. That's a $55,000 drop in 12 months. In some cities, it's even worse. Take Punta Gorda. The median home price there has fallen more than 14% year over year. 14%. That means if you bought a home there for $400,000 just 18 months ago, it's now worth about $345,000. You've lost $55,000 in equity. You might actually owe more on your mortgage than your house is worth. You're underwater, trapped, and you didn't do anything wrong. You just bought at the wrong time in the wrong market. Cape Coral, Naples, Fort Myers, the story repeats across Southwest Florida like a drumbeat. Prices falling, equity evaporating, homeowners watching their net worth shrink month after month. These aren't investors who can afford to take losses. These are families, retirees who moved to Florida for the weather and the lifestyle, working people who thought they were making a safe investment. Now let's talk about inventory, because this is where the nightmare becomes visible. In Orlando, Tampa, and Fort Lauderdale, the number of homes for sale has doubled or tripled since 2022. Doubled or tripled. Drive through neighborhoods that were hot markets just 2 years ago, and you'll see rows of for sale signs stretching down entire blocks. Homes that once sold in weekend bidding wars now sit for months with nobody making an offer. Lee County tells the story in stark numbers. In 2022, there were fewer than 4,000 homes for sale. This summer, more than 12,000. That's a 200% increase in active listings in just 2 years. 200%. The supply isn't just exceeding demand. It's drowning it. And it's not just single-family homes. Condos and townhouses, the properties that attracted remote workers and retirees during the pandemic, are now toxic assets that buyers avoid like a crime scene. Why? Special assessments, soaring HOA fees, buildings with structural problems that require millions in repairs. Nobody wants to touch them. For sellers, the math is brutal and unforgiving. You bought a home in 2023 for $445,000. You thought you were getting in before prices went even higher. Now, just 2 years later, you need to sell. Maybe you're relocating for work. Maybe you can't afford the insurance anymore. Maybe your HOA fees just tripled, so you list the house for $390 and nothing happens. No showings, no offers, so you drop the price to $375. Still nothing. You drop again to $360. Maybe you get a lowball offer for $340. And suddenly, you're staring at a loss of over $100,000 in 2 years. Price reductions have become routine. More than half of all listings in major metros see at least one price cut before getting any serious interest. Appraisers caught between falling comparables and desperate sellers report that even well-maintained properties can't justify last year's values. The gap between what owners want and what buyers will pay widens every week. This flood of inventory reflects something darker than numbers on a spreadsheet. It reflects desperation. Investors who bought during the frenzy are dumping properties at a loss just to get out. Families facing insurance renewals they can't afford are listing homes and walking away from equity. In Miami-Dade and Broward, condo owners on fixed incomes are being forced to sell after special assessments and reserve requirements push their monthly costs beyond what Social Security can cover. One owner in Hallandale Beach, 72 years old, describes selling her car to cover the first installment of a $48,000 assessment. Another in Fort Lauderdale, a single mother, broke down in tears explaining that she has to choose between paying the assessment and keeping up with her mortgage. She can't do both, so she's selling at a loss, wiping out years of equity, starting over. The result is a market defined not by scarcity but by surplus. A surplus that grows larger every month. For buyers, that means choices and negotiating power, but also the terrifying risk that anything you buy today could be worth less tomorrow. For sellers, it's a race against time and falling prices. And for Florida's economy, the stakes are measured in lost wealth, abandoned dreams, and communities watching their home values slip away like sand through their fingers. As this inventory piles up and prices keep falling, every transaction becomes a test of what Florida real estate is actually worth in 2025. And right now, the answer is becoming painfully clear. Less than anyone thought. But here's where the crisis becomes truly suffocating. Here's where the numbers stop being abstract and start destroying lives. Insurance. The insurance line item has become the breaking point for Florida buyers. The trapdoor that opens beneath them just when they think they're safe. By mid-2025, The average annual premium for a single-family home in Florida soared past $7,500. $7,500. That's more than double the national average. It's more than triple what Floridians were paying just 3 years ago when premiums sat around $2,100. Let that sink in for a moment. In 3 years, insurance costs have more than tripled. Your mortgage didn't triple. Your property taxes didn't triple. But your insurance, the thing you legally must have to own a home, the thing your lender demands before they'll fund your loan, has exploded to levels that make homeownership unaffordable for millions. In coastal counties like Lee County, premiums for modest single-family homes routinely exceed $10,000 now. Not mansions, not beachfront estates, regular middle-class homes. And in Miami-Dade, quotes hitting $16,000 or more depending on your zip code, the age of your roof, and how close you are to water. $16,000. That's more than many people's property taxes and HOA fees combined. But here's the truly insidious part. It's not just coastal anymore. Inland cities like Orlando and Jacksonville, places that rarely see hurricane damage, now have average premiums above $4,000. And buyers are being blindsided by last-minute increases that destroy their loan approvals. You get pre-approved based on an estimated insurance cost. Then, days before closing, the real quote comes in, and it's double what you were told. Your debt-to-income ratio, the magic number that lenders use to decide if you can afford the loan, suddenly shoots past their limits, and your approval vanishes. State regulators point to what they call a perfect storm: repeated brutal hurricane seasons, rampant claims fraud, especially involving roofing contractors who file false claims, and reinsurance costs, the insurance that insurance companies buy to protect themselves, that have doubled since 2022. The Office of Insurance Regulation's own filings show that more than 20 major carriers have either gone insolvent or exited Florida entirely since 2018. 20 companies gone. When that many insurers leave, the ones that remain have total pricing power. They can charge whatever they want because homeowners have no choice. You either pay or you don't own a home. One state official speaking at a closed-door summit earlier this year described the market as functionally broken. His exact words, "No one can price risk fast enough to keep up. The system has collapsed." For buyers, the shock lands late. Too late. A Tampa buyer recounts getting quoted $3,500 during the shopping process. Then, a week before closing, the final quote comes back, $7,800. The lender looks at the new numbers and rescinds approval. Deal dead. In Fort Lauderdale, a young couple watched their approval letter get torn up when their insurance jumped by $4,000 overnight. $4,000. In one day. Lenders have tightened requirements to protect themselves. They now demand proof of a paid-in-full insurance premium before they'll fund the loan. Title agents refuse to schedule closings without insurance binders physically in hand. If any detail is wrong, if the roof is too old, if an inspection is incomplete, if a carrier suddenly pulls out at the last second, the entire deal evaporates. No insurance, no closing, no exceptions. The pain isn't distributed evenly. In Lee County, Citizens Property Insurance Corporation, the state's insurer of last resort, increased rates by over 13% just this year. And for non-primary homes, for investment properties and vacation rentals, the hikes reached 50%. 50% in 1 year. Even condo owners who thought they were protected by their building's master policy are seeing annual increases of 14% or more. Here's the result. For many buyers, the annual insurance bill now rivals or exceeds their mortgage payment. Think about that. You're paying as much to insure your home as you are to own it. The math doesn't work anymore. It can't work. And so the contracts cancel. The deposits are lost. The families give up. As one state regulator said in a recent interview, affordability isn't about sale price anymore. In Florida, it's about whether you can even get to the closing table, whether you can find insurance at all, whether you can afford it if you do. And for hundreds of thousands of people, the answer is no. But the insurance crisis is just one crack in the foundation. Because while buyers are struggling to close deals, the entire insurance infrastructure beneath Florida's housing market is crumbling in real time. In April 2023, behind closed doors in Tallahassee, Florida's top regulators and insurance executives gathered for an emergency summit. The doors were locked. The press was kept out. The mood inside was described by one attendee as near panic. And within days of that meeting, several of Florida's largest private home insurers announced they were pulling out of the state entirely or halting new policies. By this summer, more than 20 major carriers had either gone insolvent or exited the market completely. 20. These aren't small regional players. These are nationally recognized companies that decided Florida was too risky, too expensive, too unpredictable to operate in anymore. They left hundreds of thousands of policyholders scrambling for coverage, often finding nothing. The Office of Insurance Regulation's own filings document a steady drumbeat of market exits and non-renewals. Some companies cite catastrophic hurricane losses that wiped out years of profits in single storms. Others point to rampant claims fraud, especially involving roofing contractors and something called assignment of benefits lawsuits, where contractors take over the claim and sue insurers for inflated repair costs. The fraud is real, it's widespread, and it has poisoned the entire market. The impact ripples everywhere. Home buyers in Miami and Fort Myers describe the scramble to secure last-minute coverage only to discover their chosen carrier stopped writing new policies 3 days before their closing date. 3 days. In Jacksonville, real estate agents report a growing number of homes now labeled uninsurable. Either the roof is too old, or the inspection found issues, or there's simply no willing carrier at any price. Title companies and lenders have responded by tightening requirements even further. No paid insurance binder, no funding. Period. When no insurer will commit, when every carrier says no, the sale dies regardless of price, regardless of how badly both sides want the deal. Citizens Property Insurance Corporation, the state's insurer of last resort, has become the only option for hundreds of thousands of Floridians. Its policy count peaked at 1.4 million in 2023. That's a number not seen since the last major market crisis. Citizens was never meant to carry this much risk. It was designed as a temporary safety net, not the primary insurer for 1 million-plus homes. And Citizens' rates are climbing aggressively. Up 13% for primary homes this year alone. Up 50% for non-primary residences. But even Citizens is now turning people away. New eligibility restrictions based on property condition and location mean some homeowners literally cannot find insurance anywhere, not at any price. Their homes become unsellable, unmortgageable, worthless. For condo owners, the situation borders on catastrophic. Master policy premiums have soared into the millions for large buildings. Some associations report being dropped altogether, leaving entire buildings at risk of violating their mortgage covenants. When a building loses its master policy, every owner's individual mortgage goes into default. Banks can call the loans, foreclosures can begin, an entire building can collapse financially because one insurance company said no. Regulators admit publicly that the system is buckling. In statements and press conferences, they blame a toxic mix of climate risk, litigation costs, and fraud. Independent adjusters speaking off the record describe intense pressure from their companies to deny or delay claims. Whistleblowers allege retaliation for reporting fraudulent activity within insurance companies themselves. The result is a shrinking marketplace where risk is priced out of reach, and the basic promise of homeownership, protection from disaster, can no longer be taken for granted. As confidential minutes from that April 2023 summit circulated among lawmakers, the message was unmistakable. Florida's insurance market is contracting faster than regulators or consumers can adapt. The question for buyers isn't how much insurance will cost anymore. It's whether it exists at all. And just when you think it can't get worse, just when you think insurance is the floor of this crisis, the real devastation hits condo owners with the force of law. After the Surfside collapse in 2021, when 98 people died as a residential tower crumbled in the middle of the night, Florida lawmakers rushed to pass new legislation. Senate Bill 4D, Senate Bill 154, bills designed to prevent another tragedy, bills that seemed reasonable on paper, bills that are now financially destroying tens of thousands of families. The law is simple and unforgiving. Every condo association in a building 3 stories or higher must complete a structural integrity reserve study, known as a SIRS, by December 31, 2025. The study isn't optional. It isn't suggested. It's legally mandated. Associations must hire licensed engineers or architects to inspect roofs, load-bearing walls, plumbing, electrical systems, fire protection, and every major building component worth more than $25,000. And here's the part that's crushing people. The findings are binding. If the engineer's report identifies a funding gap, if the building needs repairs or lacks adequate reserves, the board is legally required to collect enough money to cover projected repairs over the next decade. Immediately. There's no wiggle room, no delay. The law allows only a brief pause if owners vote to approve it, and even then only for urgent safety repairs. For residents, the legal language translates into immediate financial catastrophe. Board presidents across Miami-Dade and Broward now face packed, angry meetings where they read from the state's guidance and explain what the law requires. One board president, her voice shaking, tells a room full of frightened owners, "We have no choice. If the SIRS says we need $1.2 million in reserves, we must start collecting, monthly, quarterly, or in a lump sum, before our next insurance renewal, before anyone can get a new loan. We have no choice." The deadline looms over every association like an executioner's blade. Any building that fails to comply by the end of 2025 faces state fines, potential lawsuits from owners, and insurance non-renewal. And if you lose insurance, the banks call every mortgage in the building, every single one. Foreclosures begin. The building dies financially. The mechanics are relentless. Associations can levy ordinary monthly dues, special assessments, or even take out loans to fund reserves. But every dollar must be accounted for and justified. The Department of Business and Professional Regulation, Florida's DBPR, issues regular reminders and sample reports making crystal clear that noncompliance isn't a bureaucratic hassle. It's an existential threat to the entire building. Owners who bought condos expecting stable, predictable fees now receive certified letters announcing that their monthly dues are doubling or tripling. The explanation is always the same. This isn't the board's decision. This is the law. We have no choice. And the mandate doesn't just affect Miami's oceanfront luxury towers. Any condo or co-op with 3 or more habitable stories falls under this rule. That includes mid-rise buildings in suburban Orlando, older complexes in Tallahassee, modest townhome communities across the state, thousands of buildings, hundreds of thousands of owners. For buyers who closed after 2022, who thought they were getting a deal in Florida's cooling market, the SIRS deadline means sticker shock is now a permanent feature of ownership. And there's no escape. You can't opt out. You can't vote it away. The law is the law. As December 2025 approaches, the pressure on boards and owners intensifies by the day. Meetings that once handled routine maintenance approvals now devolve into shouting matches. Owners demand answers the boards can't provide. Engineers deliver reports with price tags that seem impossible, and everyone understands that the clock is ticking toward a deadline that will change everything. And now we get to the part that breaks people. The actual numbers. The bills landing in mailboxes that make owners physically ill. Across Florida, condo owners are opening envelopes containing assessment notices that would have seemed like cruel jokes just a few years ago. In Miami-Dade, Broward, and Palm Beach counties, associations are delivering demands for lump sums as high as $80,000 per unit. $80,000, due within 90 days in some cases. These aren't theoretical numbers. These are real bills being sent to real people right now. One board president in Hallandale Beach, her voice trembling as she reads from the engineer's report at a packed meeting, says, "We are required by law to collect $1.7 million for structural repairs and reserves. That comes to $48,000 per owner. Due within 90 days. The room erupts. Owners shout. Some cry. One elderly woman faints and has to be helped outside. $48,000, 90 days. For retirees living on Social Security and small pensions, these assessments represent more than they have in savings, more than they could borrow, more than they can earn in years." A 72-year-old woman in Hallandale Beach describes selling her car, her only car, to cover the first installment. She now takes buses to medical appointments. She can barely afford groceries, but the assessment keeps coming due. In Fort Lauderdale, a single mother on a fixed income sits in her condo and sobs as she explains the impossible choice. Pay the assessment or keep up with her mortgage. She can't do both. The math doesn't work, so she's selling. But who's going to buy a unit with a massive pending assessment? She'll sell at a loss. She'll walk away with nothing. Years of equity, her entire life savings gone. The stories repeat across South Florida like a nightmare echo. $15,000 up front, then $900 a month for 5 years. $22,000 due in 60 days or face a lien on your property. $35,000 to avoid being in violation of the reserve mandate. The numbers vary, but the desperation is universal. Some associations offer payment plans, spreading the pain over years instead of months. But the sums are still staggering. Even with a plan, many owners simply cannot afford it. For them, selling becomes the only escape. If they can find a buyer, if anyone will touch a condo with these kinds of assessments looming. Realtors report a surge of listings from desperate owners trying to get out before the next bill arrives. In older buildings, especially those built before 1980, the engineer's findings are often catastrophic. Failing roofs that need complete replacement, corroded plumbing that's been leaking inside walls for years, concrete spalling where the rebar is exposed and rusting, balconies that are unsafe, electrical systems that don't meet code. The cost of decades of deferred maintenance landing all at once on current owners. In one North Miami complex, more than a quarter of the units hit the market within weeks after the board announced a $62,000 per unit special assessment. $62,000. Many of those owners will sell at a loss, erasing years of equity, walking away with nothing or even owing money at closing. The emotional toll is everywhere and inescapable. Board presidents field death threats. Angry emails accuse them of corruption, of being in bed with contractors, of destroying lives. But their hands are tied by state law. One president, near tears herself, tells a room of furious owners, "If we don't collect these reserves, we lose our insurance. If we lose insurance, the bank calls every mortgage in this building. There is no option. There is no choice. I'm sorry." The compounding burden of skyrocketing insurance, mandatory reserves, and special assessments has turned what was supposed to be the security of homeownership into a source of constant fear and financial ruin. In hallways and elevators, neighbors who used to chat about weather and grandkids now trade stories of foreclosure threats and bankruptcy, each wondering who will be next to receive the certified letter that changes everything. For thousands of Florida condo owners, the American dream has become an American nightmare. And there's no waking up. But wait, because somehow, impossibly, it gets even worse. Because on top of insurance chaos and crushing assessments, many condo boards themselves are imploding from within. Legal threats now swirl through condo boardrooms across Broward and Miami-Dade like a toxic storm. Accusations of self-dealing, corruption, and outright fraud have escalated from whispered complaints into open warfare, complete with lawsuits, injunctions, and criminal referrals. In Hallandale Beach, a group of owners filed suit against their own association, alleging that the board president pushed through a no-bid contract with a management company tied to his own family. The complaint, now public record, details late-night meetings where votes were rushed through, reserve funds redirected without proper owner consent, and financial records that don't add up. The owners claim millions in association funds have been mismanaged or worse. In another Miami-Dade building, residents discovered that the treasurer concealed the true size of a coming assessment until after the board renewed a lucrative contract with his preferred vendor. A vendor that, financial records later showed, had made significant donations to his last board campaign. When owners demanded answers, they were shut out of meetings. When they demanded financial audits, they were threatened with legal action for harassment. Court dockets across South Florida now list dozens of cases pitting residents against their own boards. Owners allege improper reserve accounting, conflicts of interest in hiring engineers for mandatory SIRS reports, and kickback schemes involving contractors. In one Broward case, a judge ordered a temporary injunction after owners produced emails showing a board member actively lobbying for a specific contractor who later won a $1 million repair contract. The emails were damning. The board member insisted everything was legal. The judge disagreed. Board presidents under mounting scrutiny insist all decisions followed the law, that they were just trying to meet impossible state deadlines and keep buildings in compliance. But for many owners, trust is shattered beyond repair. At recent meetings, attempts to discuss budgets or assessments are drowned out by shouts of recall. An audit. Owners demand to see every invoice, every contract, every check. Boards, feeling attacked and overwhelmed, dig in or resign altogether. These lawsuits are more than angry neighbors fighting. They threaten to freeze critical repairs that buildings desperately need. They delay insurance renewals, putting entire buildings at risk of noncompliance. Banks have begun flagging properties with ongoing litigation, making mortgage approvals nearly impossible and scaring off what few buyers might have been interested. Real estate agents now warn clients to review board meeting minutes going back years and check for pending lawsuits before making any offer on a condo. Even a hint of board instability can kill a deal. The dysfunction at the heart of many associations is driving even more owners to list their units, desperate to escape before the next scandal breaks or the next lawsuit lands. The promise of condo living, shared responsibility, shared costs, shared benefits has fractured into suspicion, anger, and expensive litigation. What was supposed to be a community has become a battlefield, and the casualties are measured in destroyed relationships, lost equity, and families forced to abandon homes they can no longer afford or trust. As boardroom turmoil spreads, as lawsuits multiply, the already fragile market grows even more unstable. Because who wants to buy into a war zone? Now, while condo owners fight their boards and insurance companies flee, another crisis is quietly strangling what's left of Florida's housing market, affordability itself. Mortgage rates hovering near 7% have redrawn the boundaries of who can buy a home. For first-time buyers, the math is no longer just difficult. It's often impossible. Here's what 7% actually means. In 2021, a $400,000 home with 20% down and a 3% interest rate meant a monthly payment of about $1,350 for principal and interest, manageable for a middle-class family with decent income. Today, that exact same loan at 7% costs nearly $1,900 a month. That's a 40% increase in just 4 years. 40%. And remember, that's before property taxes, before homeowners insurance at $7,500 a year, before HOA fees that can run $700 to $1,500 monthly. When you add it all up, that $400,000 home now costs over $3,000 a month, maybe more. For lenders, the problem is simple: debt-to-income ratios. Banks want your total monthly debt payments to stay below a certain percentage of your gross income, usually around 43% for conventional loans. When your housing costs alone push you past that threshold, you don't qualify. Period. In Jacksonville, a young couple describes their nightmare. They got pre-approved back when rates were around 5%. Their buying power looked solid. They spent months searching for the right home, finally found one, made an offer, got into contract. Then rates ticked up to 6.5%, then 7%. By the time they were ready to close, their monthly payment was $500 higher than the original estimate. Then the insurance quote came in at $6,000 instead of $3,000. Their debt-to-income ratio shot past 50%. The lender withdrew the approval. The deal died in underwriting. They lost their inspection fees, appraisal costs, and months of their lives. For nothing. Appraisal gaps have become the norm in Florida's falling market. Buyers agree to pay $390 for a house, but the appraisal comes in at $360. That's a $30,000 gap. Either the buyer covers it in cash, the seller drops the price, or the deal falls apart. With rates at 7%, most buyers don't have an extra $30,000 lying around. And sellers, desperate as they are, often refuse to cut deeper. So deals die. Buyers in Orlando report appraisals routinely coming in $20,000 to $40,000 below contract price. They try to renegotiate, but even with price cuts, the monthly payments at 7% make the numbers impossible. The math just doesn't work anymore. For first-time buyers, people trying to enter the market for the first time in their lives, Florida has become a wall they cannot climb. Every percentage point in interest rates translates to hundreds of dollars in lost affordability. A buyer who could afford a $450 house at 3% can now only afford a $320 house at 7%. That's a $130,000 drop in buying power through no fault of their own. Investors are feeling it too. Rental yields, the profit made from renting out properties, are eroded by higher borrowing costs. Cash flow that looked strong at 4% evaporates at 7%. Many investors are simply walking away, deciding that Florida's risk-reward equation no longer makes sense.